Ray Dalio, the founder of Bridgewater Associates, which is the largest hedge fund in the entire world, warned that the stock market is in a bubble, halfway to the magnitude of those that triggered historic market crashes like the Dotcom Bubble and the Great Depression. He believes that with the influx of money being injected into the markets, people are buying all assets and pushing yields down. As per Dalio, there are classic bubble dynamics in so many different assets, and we could soon experience a market crash. So, what are the indicators that Dalio uses to anticipate a potential crash? The stock markets across the globe have seen a sharp recovery from March 2020 lows and continue to go strong. But the run up has prompted top investment experts rushing to figure out if there is a bubble forming in the US. Stock markets billionaire hedge fund manager Ray Dalio believes that there are signs of concerns. The recent up move charted by equity markets comes at a time when governments continue to inject money into the economy through the stimulus. Interest rates continue to sit at an all-time low and inflation continues to rise. Some believe that stock markets are roaming in dangerous territories, but is the current situation similar to that of a stock market bubble? To answer this, Dalio uses the 6 indicators to determine if financial markets are in a bubble. He uses the framework of 6 indicators to determine if a stock market bubble is unsustainable. Dalio rates each of the influence measures in the framework based on a rating, which collectively determines the health of the broader stock market. The rating measures for the individual influence measures are determined on a scale of best to worst as follows: no bubble, somewhat frothy, frothy and bubble. During the Great Depression and the dot-com bubble, all 6 individual measures were measured as a bubble and signaled an immediate unsustainable collapse. The individual measures that Dalio uses to determine the health of the stock market are as follows. Number 1. How high are prices relative to traditional measures? Number 2. Are prices discounting unsustainable conditions? Number 3. How many new buyers have entered the market? Number 4. How broadly bullish is sentiment? Number 5. Are purchases being financed by high leverage? Number 6. Have buyers made forward purchases to speculate on future gains? So let's start with the first indicator. How high are prices relative to traditional measures? The current prices for US equities are in the 82nd percentile, which according to Dalio is somewhat frothy. Dalio tracks a basket of over 500 stocks to measure the volatility and the performance. This is just shy of the prices in the 1929 bubble. Dalio believes that the current prices are reminiscent of stock prices in the early 1970s and the dot-com bubble stocks in the late 1990s. Now moving to the second indicator, are prices discounting unsustainable conditions? Dalio measures future earnings by estimating the earnings growth that is required to produce equity returns in excess of bond returns. Currently, the indicator is in the 77th percentile for the aggregate market, which indicates that the market is frothy. This indicator shows that while stock prices in aggregate are high in relation to the absolute returns they are to provide, they are not extremely high in relation to their bond market competitors. In both 1929 and 2000, this measure was at the 100th percentile. The third one, how many new buyers have entered the market? Dalio believes that a rush of new market participants attracted by rising prices is often indicative of a bubble. That is because they are typically entering the market assuming that there's lots of money to be made. This was the case in both the 1929 and 2000 equity bubbles. This GOG has recently reached the 95th percentile due to the flood of new retail investors into the most popular stocks, primarily with the help of leverage. Now, how broad bullish is sentiment? The more bullish the sentiment, the more people have already invested. So it is less likely they will invest more and more likely that they will sell. The aggregate market sentiment GOGs is now around the 85th percentile. Once again, it is heavily concentrated in the bubble stocks rather than most stocks. IPOs have been exceptionally hot and have had a run-up, which is similar to that of the 2000 bubble. The current IPO pace has been brought about by the sentiment as well as the special purpose acquisition company boom, as these blank check acquisition companies have lower regulatory hurdles and greater flexibility to bring more speculative companies into the public market. Are purchases being financed by high leverage? Leveraged purchases make the underpinnings of the buying weaker and more vulnerable to forced selling in a downturn. Ray Dalio uses a leveraged case to measure the leverage dynamics across all the key players and treats option positions as a form of leverage. This measure is now showing a rev just shy of the 80th percentile. Like other indicators used by Ray Dalio, this measure indicates that there's high leverage being deployed by the retail segment through the use of options. This is particularly true in meme or bubble stocks such as GameStop and AMC, where other parts of the market show much less leverage. Dalio believes that the volume in single stock call options is at record highs. Now the last indicator, have buyers made forward purchases to speculate on future price gains? One perspective Dalio looks at while determining if the market is reaching a bubble is by looking at forward purchases made by investors to speculate on future price gains. Dalio and his firm Bridgewater particularly finds it helpful in commodity and real estate markets, where foreign purchases are most clear. In equity markets, Dalio looks at indicators such as capital expenditure, which help indicate if companies are investing into infrastructure development for the future. This helps determine if the current demand will be persistent in the future. This indicator has the lowest weightage across all the other previous indicators that I have discussed with you. The current aggregate capex has fallen in line with the pandemic-driven hit to demand. While certain software companies have managed to maintain their levels of investment, similar levels of mergers and acquisitions activity continues to remain subdued so far. Companies have chosen to be conservative with their investment and preserve cash, as concerns about a resurgence in the pandemic have sparked fears. With US stocks at levels that seem to defy the economic realities that are facing businesses as a result of the global pandemic, market experts have been focused on whether or not it's a bubble. Dalio believes that the assessment of the current market is mixed. According to Dalio and Bridgewater, the broader market is frothy while emerging technology companies are in bubble territory. He also believes that about 10% of the top 1000 US companies are currently in a bubble. But Dalio is questioning investors by saying that the current market action is reminiscent of the stock market in the early 1970s and the dot-com bubble stocks in the late 90s. Now, I want all of you to please let me know your thoughts about the market crash that is predicted by Ray Dalio. What do you think? Will there be something gonna like this very soon in the near future or not? And please appreciate my efforts by liking this video and subscribing to our channel. Also, don't forget to share it with your financial community. Bye bye and take care.